You've got $100,000 to invest. Now comes the real question. Where do you put it? Two of the biggest contenders, VTI and SCHD. One is built for steady dividends and passive income, while the other is a total stock market beast designed for long-term growth and capital appreciation. So which one will actually make you more money? Which one survives market crashes better? And which one fits your investment goals best? In this video, I'll compare VTI and SCHD side by side. We'll break down their investment strategies, dividend growth versus capital appreciation, the risks involved, and finally, what happens if you invest $100,000 in each over 30 years? One ETF wins by a landslide, turning $100,000 into over $4.7 million and paying $31,000 per month in passive income. Stick around, because this decision could shape your entire financial future. What are VTI and SCHD designed for? Both VTI and SCHD are ETFs, but they play completely different games. SCHD, the dividend powerhouse built for consistent cash flow and dividends, holds 100+ high-quality dividend stocks, focuses on financials, healthcare, and consumer staples, pays you every quarter, real, tangible money. If you want an ETF that generates income while growing your wealth, SCHD is built exactly for that. VTI, the total market growth monster, checkmark, holds every stock in the US market, over 3,600 companies. Checkmark, heavy exposure to tech giants like Apple, Microsoft, Amazon, and Nvidia. Checkmark, no focus on dividends, purely capital appreciation. Checkmark, captures the entire market, high risk, high reward. If you want long-term, broad market exposure, VTI is the ultimate set it and forget it ETF. The real question: do you want an ETF that pays you regularly, or do you want maximum growth? To answer that, we need to go deeper. Let's break down exactly what's inside these ETFs. What's inside these ETFs? SCHD, a focused list of dividend titans. Checkmark, top holdings: Pfizer, Coca-Cola, BlackRock, ABB. Checkmark, heavy in financials, healthcare, and consumer staples. Checkmark, built for dividend stability, resilient during market crashes. These companies are cash machines. Even in a recession, people need medicine, groceries, and banking. VTI, a giant slice of the entire economy. Checkmark, holds over 3,600 stocks, including every industry. Checkmark, top holdings: Apple, Microsoft, Nvidia, Amazon. Tech heavy. Checkmark, tech makes up nearly 30% of its portfolio. The upside? Huge long-term growth. The downside? Bigger market swings and volatility. So now that we know what's inside these ETFs, let's look at what really matters: performance. Which one makes more money? 1-year performance: SCHD, plus 8.88%; VTI, plus 21.47%; Checkmark, tech-fueled bull run, 5-year performance: SCHD, plus 45.74%; VTI, plus 79.6%; Checkmark, again, tech boom dominance, 10-year performance: SCHD, plus 114.37%; VTI, plus 178.77%; Checkmark, huge lead. But wait, there's more to this story. At first glance, VTI seems like the clear winner. But here's where things get interesting: these numbers don't include dividends. SCHD investors get paid every quarter, on top of stock appreciation. So what happens when we factor in those dividends? Let's run a 30-year wealth simulation. What happens if you invest $100,000? VTI, long-term growth powerhouse. Checkmark, 1 year, $112,120; Checkmark, 10-year, $284,980; Checkmark, 20-year, $922,000; Checkmark, 30-year, $2,749. VTI is great for long-term wealth, but what about passive income? After 30 years, VTI's dividends only pay $953 per year. That's about $79 per month, not even enough for groceries. SCHD, the dividend growth machine. Checkmark, 1 year, $111,280 checkmark 10-year. $307,400 checkmark 20-year. $1,896,000 checkmark 30-year. $4,733,000. But here's where SCHD dominates. Annual dividend income. $375,900, that's $31,325 per month. Completely passive. SCHD turns your portfolio into a money printing machine. Which ETF wins? VTI wins if checkmark you want maximum long-term stock appreciation, checkmark you're okay with market volatility, checkmark you don't care about dividends and just want growth. SCHD wins if checkmark you want a stable, high-income portfolio, checkmark you love passive income and cash flow, checkmark you want both stock growth and dividends. Which one should you buy? Both ETFs are amazing, but which one is right for you depends on your investment goals. Want steady cash flow and passive income? Go with SCHD. Want long-term capital appreciation? Go with VTI. What's your pick? Comment below. I'd love to hear your thoughts. Want even more dividend investing tips? Click the video on the screen to see how QQQ crushes SCHD by $8 million. Like, subscribe, and turn on notifications for more investing strategies.